Hello everyone, this is Tejashwini. In today's session, let's continue the discussion of the capital gain. This is going to be part 2 of the capital gain revision. If you haven't watched the part 1 of the capital gain, please go and watch that video first and then you can continue watching this video. Okay, so now let's continue our discussion with the next part of the revision, that is the wherein your capital gain. So, normally speaking, capital gain is subject to tax in the year of transfer. But there are certain situations, exceptional circumstances, wherein the capital gain will not be taxable in the year of transfer. That is when the sale, when the compulsory acquisition, and so many things happen. It will be taxable in the year of actual receipt. Okay. So, what are those situations? Are these? These are the three situations. That is, the first situation is the insurance receipt. People, all of us know when the capital asset is burned down or because of some situation, natural disasters or some accidental events, the capital assets gets written off, that is gets damaged. And now when the insurance receipt is, when you're supposed to receive that insurance receipt, you're not going to receive it immediately, that is within some 10 days, 15 days, within 1 2 months, 3 months, like that. It might take some years together for them to receive that insurance receipt. It might take 1 year, 2 year, 3 year, etc. Suppose in PY 21-22, the capital asset has been burnt down because of the natural calamities. And in PY 23-24, you are receiving that insurance receipt from the insurance company. Okay. So in these situations, what you will do is very simple. When the year of transfer has taken place in 21-22, but and the capital, if it is a asset which is subject to indexation, your period of holding will stop till year. But you're going to make it as taxable in the PY 23-24. Next. Conversion treatment or conversion of a treatment of a capital asset as a stock in trade. Try to understand one point over here, people. See, when you are converting your capital asset as stock in trade, it means you were having, that is, you have purchased 1 acre of land, suppose, and you have converted that into plots. You have purchased this land in PY 78, suppose. In PY 78, you have purchased this capital asset, and in 1819 PY, you have converted that capital asset into stock in trade. That is, you have 1 acre of land, you have converted that into 30, 40, 60 by 100 site and you are selling it. Okay. And you are converted that into stock in trade in the year PY 1819. And in PY 23-24, what has happened is that you have converted that stock in trade. No, it has been sold in PY 23-24. It has been sold. That is, it has been sales has happened in this 23-24. If you want to understand, if you observe something, your capital asset has stopped being a capital asset when it has been converted into stock in trade. That is in PY 1819. If you take it as a timeline, if you want to understand this, take it as a timeline. PY 78 is the year of purchase. PY 1819 is the year of your conversion, is the date of, that is year of conversion, date of conversion. PY 23-24 is the year of your actual sale. So if this has happened, what you will do is very simple. Up till year, up till this point of time, that is the date of conversion which is coming up to till 1819. What you will do is very, very simple. Till this point of time, whatever the year you have, you are holding your asset as your capital asset till this point of time, right? And this point of time, whatever you are holding it as stock in trade. So up till this point of time, till PY 1819, it is going to be considered as your capital asset. And after PY 1819, it is going to consider stock in trade. It means it is taxable as your capital gain year. It is taxable as your PGBP year. Simple. Done. See, now try to understand what we are going to do with regarding to the taxability. Okay. First of all, in the year of conversion, in this year, I have taken it as 1617. We'll take the same year. See here, we have taken 1819 as the PY, right? We will consider 1819 in my example, 1819 as my PY. Okay. 1819 is the year of date of conversion. Year of conversion is 1819. Let's consider 31st March 2019 is the year of conversion. Okay. First of all, you have to take it, settle year. You are going to consider, let's consider fair market value as on this date is 1 crore. It means, suppose you would have taken that capital asset, sold it in 1819 in my example, as your capital asset only, instead of converting it into stock in trade, you would have sold it as capital asset only. That is, you would have sold at a fair market value of 1 crore only. So what I will do is that for the purpose of capital gain, I will say 1 crore is my capital gain that I need to consider. Clear? 1 crore is the capital gain. So if I would have sold, instead of converting it into stock in trade, I would have sold it at 1 crore. That is the reason. The fair market values on the date of conversion would be my first point. Next, index to cost of acquisition or index to cost of improvement, whatever is there, that one I'm going to consider. However, I'm going to get my indexation benefit, right? Indexation benefit is, however, available for me. I'm going to take the same indexation benefit over here, as usual, available for the capital asset for me, and I'm going to take it. Suppose in my example, I've just taken a random amount of 60 lakh rupees as my indexation benefit. I've taken my capital gain subject to tax is 40 lakh. Okay. Try to understand something, people. Sale price over year. Let's consider the sale price is 1.5 crores. Okay. Just an example, 1.5 crore is the sale price. That is the entire capital asset, whatever is converted into stock in trade. The entire stock in trade is been sold in 23-24. So it is taxable in the year of receipt. I am going to take it as 1.5 crores in my example. After writing over there, fair market value and the date of the conversion is, people, see, whatever capital asset and PGBP transaction that you are recording, it is for one asset only. That is, it is one transaction only, but amount is been taxable under two different head. Try to understand. So for that entire asset, the capital, that is the amount which you got for that asset, is going to be 1.5 crores. No. So 1.5 crores is going to be the total amount that you have considered. Total amount that you are going to record it. The total amount that you are going to record it as you have received it. That is, sale price is equal to 1.5 crores. Clear? After this, after 1.5 crores, then what you are going to consider is, out of this 1.5 crores of this land being converted into stock in trade, for this entire amount you have received 1.5, that is the total amount subject to tax. Right? Now, out of this 1.5 crores, which is subject to tax, you've already taxed 1 crore years as capital gain here. Understanding? Only remaining 50 lakh is subject to tax under your PGBP. It is already subject to tax over here. So, 1.5 minus the date of conversion, as on the date of conversion, the amount which I have already recorded for tax, I am going to record here. Remaining 50 lakh, whatever I have, this is going to be my PGBP income. Clear? This is going to be my PGBP income. I hope it is clear. This is going to be a revision series, people. So we are going to do the revision, not an in-depth explanation. We are going to keep it the revision. Okay. Next, compensation on compulsory acquisition. My compensation on compulsory acquisition. Try to understand one thing, people. Compulsory acquisition as to what? Enhanced compensation as to what? See, you have a property over there, over in one place, you have a property. Now the government wants to compulsory acquire through road. They have taken away your property. That is the compulsory acquisition under law. For the compulsory acquisition, they are going to give you a compensation over here, or a enhanced compensation. See, for the property being taken over, government is going to give you some amount, that is in the form of compensation. Suppose government has given you 10 lakh and you are stating, no, I want some 25 lakh for that. That 15 lakh of whatever increase that you are recording, after receiving this 10 lakh rupees as an initial compensation, as the first set of compensation, you are going and again applying for enhanced compensation. This 15 lakh is called as more compensation that you are receiving. That is nothing but the enhanced compensation. Clear? Now, Compulsory enhanced compensation. Remember one thing, people. In case of compulsory compensation, whatever the compensation that you have received, it is subject to tax in the year in which it is received. Whichever year it has been taken over. No, 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 it is not taxable in the year of taken over. It is taxable in the year of receipt, whenever you have received the money from the government. Enhanced compensation also, it is taxable in the year of receipt. Cost of acquisition for enhanced compensation will be, obviously, for enhanced compensation is going to be nil. Remember, for the enhanced compensation, it is going to be nil. Just let's take an example. For compulsory acquisition, you have got the normal compensation, first time compensation of 10 lakh. Let's consider your actual cost of acquisition, index cost of acquisition is resulting in 8 lakh. Now, how much you're going to get over here? 2 lakh rupees is what you would get, correct? 2 lakh rupees is what you would get. And in this case of 2 lakh, this will be taxable as your long-term capital gain depending on the period of holding. Simple. For the same asset, now you are applying that I want 15 lakh, that you have received the 15 lakh. Total compensation, first set of compensation you have asked for 10 lakh, you have got. Again, you are going and applying for enhanced compensation of 15 lakh, you have got. How much is it? 15 lakh. Now, in this 15 lakh, tell me, people, this 10 lakh and 50 lakh total combined, you have received for one asset only. For the entire asset, you have already taken the cost of acquisition. Yeah. How can there be another cost of acquisition in case of enhanced compensation? It will always be nil. Try to understand. It will always be nil. Okay. Now, when it comes to interim orders is deemed capital gain and it is taxable for the final court decision. That is, interim orders means you are going to receive interim order, multiple order. Remember, whatever the compensation you have received in the interim orders, that will be taxable at the final court decision only, because it can change. Now, death of a transferor, for that matter, in case of the death of a transferor, whosoever is receiving that capital gain amount, whosoever is receiving that compensation is subject to pay the capital gain. Clear? Now, section 46 speaks about capital gain on distribution of asset by companies in liquidation. Okay. So now what is this speaking about is very simple. This capital gain, whatever you are recording over here on distribution of asset by companies in case of liquidation, try to understand one point. There is a concept of deemed dividend which comes over here. Okay. Capital gain on distribution of asset by companies in case of liquidation. See, when the company is distributing the asset, now two concepts will come into picture. One is the capital gain taxation for the distribution of asset, and another one is the deemed dividend. Now comes the question, where, in whose hand it will be taxable? Always remember, the capital gain or distribution of capital, that is asset by companies, in the hands of the company, it is not a transfer at all. So there is no capital gain liability coming in. In the case of a shareholder, remember, there will be 2 points coming into picture. One is a deemed dividend and one is the full value of consideration. Okay. In case of deemed dividend under section 2 subsection 22C, this is going to be taxable in the hands of the shareholder as income from other sources. And in case of you classifying this money, whatever the other than deemed dividend over here, see here, money received plus fair market value of the asset distributed minus the deemed dividend, whatever you are recording. If you are subtracting this deemed dividend from here, you are going to get the full value of consideration for the purpose of section 48. That is nothing but in the hands of the shareholder. When I am receiving the asset, the company is distributing the asset, I am going to classify it under two heads. One is deemed dividend and one is to that extent of other than deemed dividend. Whatever I have received other than deemed dividend, I am going to subject to pay to the capital gain and over here. Everyone, people, this is not a regular class, so I'm keeping it very simple to that extent of revision. In my regular class, I would have explained what is meant by deemed dividend, why are we doing the subtraction, everything. This is a revision. We will get to the point of revision. Okay. Next, section 46A speaks about capital gains on buyback of shares of specified securities. See here, in case of buyback of shares, what is meant by buyback? I am the company, I have listed my shares, and out of that 1 crore listed shares, I want 20 lakh shares to be buyback. That is, I want to buy back those shares. Means I don't want that 20 lakh shares to be existing in the market. I want only 80 lakh shares to be existing in the market. Not one, no, not that remaining 20 lakh. So I will buy back those shares. Buyback means company is taking back, buying back its own shares. That is what buyback of shares means. Okay. See, buyback of shares in case of taxability in the hands of the company, it is subjected to the tax by the domestic company. If the buyback of shares is happening by the domestic company, then it is subject to additional tax at the rate of, that is, tax at the rate of 20% and surcharge plus HEC. Total is going to be 23.296%. If it is taxable in the hands of the shareholder of the specified securities, then income arising from the shareholders shall be exempt. Or if it is already taxable in the hands of the company, why will be again taxable in the hands of the shareholders? So once it is taxable in the hands of the domestic company, it is not taxable in the hands of the shareholders. If the buyback of the shares happen other than the domestic company, it is not taxable in the hands of the company, it is taxable in the hands of the shareholder. If the buyback of the specified securities by any company happens, it is not taxable in the hands of the company, it is taxable in the hands of the shareholders. Section 47 speaks about the transaction which is not regarding as transfer. Remember, if it is not a transfer, even though it is a capital asset, still we are not going to treat it as a capital gain. Remember this point. Okay. Section 47, that is the total or the partial partition of an HUF. When the when there's a partition that is happening in HUF and the capital asset are being transferred from the HUF to the individual members, it is not subject, it is not regarded as transfer. Remember, it is not a transfer, it is not a capital asset. Sorry, if it is not a transfer, it is not a capital gain, not a capital gain, no capital gain tax. Remember this point. Okay. A gift or a will or irrevocable trust, if you are getting, again, it is not treated as a transfer. Transfer of a capital asset by holding company to its wholly owned subsidiary. That is, if they're a wholly owned subsidiary, capital asset is being transferred by the capital by the holding company to its subsidiary, then what happens? Then any capital asset which is being transferred subject to satisfying these two conditions, that is the parent company or its nominee must own all the shares of the subsidiary and the subsidiary must be an Indian company. If these two conditions are satisfied, then it is not going to be a transfer. Again, vice versa situation when the subsidiary company transfers to its 100% only owned, that is 100% holding company, then again it is not going to treat it as transfer, not a transfer at all. The capital transfer of a capital asset by amalgamating company to the amalgamated Indian company in the scheme of amalgamation. That is two companies coming together. Here A Limited and B Limited coming together to do the business, forming AB Limited. Asset of A Limited being transferred to AB Limited, B Limited transferring to AB Limited. This transfer of capital asset which happens over here in the scheme of amalgamation is not a transfer. If it is not transfer, it is not a capital gain. Okay. Transfer of a capital asset by a demerged company in a resulting Indian company. That is, there was AB Limited first and now it is demerged. Now it has been splitted. That is demerged into AB Limited. Asset which is transferred from AB Limited to separately to A Limited and B Limited, it is not regarded as transfer. Okay. Transfer or issue of shares by resulting company in the scheme of demerger, same thing. That is, in the resulting company in the scheme of demerger, see, the shareholders of AB Limited will now be given shares of A Limited and B Limited. Shareholders will get the shares in A Limited, B Limited. Now the shareholder is transferring the share from AB Limited to A Limited. No. So whatever the transfer that is happening, it is not regarded as transfer at all. Okay. So transfer of shares by the shareholder in the scheme of amalgamation, same similar point has whatever we have seen people. And transfer of government securities outside India by non-resident to another non-resident, it is also not regarded as transfer. Redemption of the sovereign gold bonds by individual, if the individual is redeeming the sovereign gold bonds, then even that is not regarded as the transfer. Conversion of gold into electronic gold receipts and conversion of the electronic gold receipts into gold, it is also not regarded as transfer. Transfer of a specified capital asset to the government or universities. If you are transferring these situations, these sort of capital asset into that institution, to the government or institution, if you are transferring, still it is not regarded as transfer. Still, it is not regarded as transfer. Transfer of the conversion of the bonds or debentures or shares. If you are converting your bonds or debentures into shares or securities, not regarded as transfer. Conversion of your preference shares into equity shares, not regarded as transfer. Conversion of a capital, transfer of a capital asset under the reverse mortgage is also not regarded as transfer. Clear? Now, ascertainment of cost in specified securities. That is, this point is going to be important. If your asset is getting transferred in this way, in the way where the capital asset became the property of the assessee, that is in the distribution of asset in an Indo undivided family, receipt of assets through will, gifts, or inheritance. People, if this capital asset became the property in case asset has been distributed by HA, if you have received through gift, will, inheritance, if you are receiving through liquidation of a company, transfer of a revocable asset, exemptions for an income company transfer between holding company and result company, that is asset received from the merging company to the amalgamated company. Demerged company, from a demerged, received from a demerged company during the demerger. Conversion of a capital separate property into HA. If you are getting the capital asset in these three category, in these category, whatever you have seen, and such cost of acquisition shall be the price at which the previous owner bought the property. See, first of all, if you are getting the property in this way, now comes the question how you are going to treat that as your cost of, that is your cost of, what would be the cost of acquisition for this? If you observe something carefully, array, think if you have received some property as an inheritance in your name, have you paid any money for your parents or for your grandparents for the inheritance? No. So your ideal cost of acquisition, money moving out of your pocket would be nil, people. Normally speaking, it would be nil. Correct. So if that is the case, your cost of acquisition, first of all, the property is received from the inheritance, that is from your parents. Your whatever the cost involved with your parents will be your cost of acquisition. That is the, you will be the current owner. The one who transferred the property to you will be the previous owner. That is, the previous owner bought the property is considered as the cost of acquisition. They will be considered as, the cost of acquisition would be considered as that. That is, the cost of the previous owner would be your cost. The improvement which is done by the previous owner will be your improvement, which you can take for the purpose of indexation. And also whatever you have incurred as the cost of improvement also you can take. That should be on or after 1st April 2001. Remember. Period of holding. The period of holding from your parents, that is from your previous owner, becomes your period of holding. Indexation benefit can be taken right from the period of holding from the previous owner. From that year, you can start your period of holding till the asset gets transferred. You can consider that as your period of holding. Clear? Now, now let's get into a next important one. That is the section 50A. That is the computation of capital gain in case of depreciable asset. Okay. Computation of capital gain in case of depreciable asset, people. See, try to understand one thing here. When there's a transfer of capital asset, that is a depreciable asset happening, always remember it is always going to be short-term capital gain only. You can never get long-term capital gain in case of your transfer of depreciable asset, even though the period of holding might be beyond 36 months. It's always and always going to be your short-term only. You can never get long. Okay. It can be either short-term capital gain or short-term capital loss. It cannot be anything else. Okay. Now, so in case of transfer of depreciable assets, whatever the tax consequences, how you are going to deal is very simple. V is represented as full value of consideration. V is represented as the full value of the consideration. And C is represented as the WDV, that is the opening plus actual plus whatever the connections which has happened. That is, you are going to consider the actual, that is, you are going to consider the WDV value. If the consideration is greater than the WDV value, if the full value of considerations whatever you have received is greater than the WDV value of the asset, and the block is not there only. People, you guys remember what is meant by block? Block is in your taxation. Your asset loses its individual identity, everything gets classified as a block. So if the block is lost, then what happens? Your full value of considerations minus your WDV, whatever the WDV minus your full value of consideration. That is, if your full value of consideration is 10 lakh minus your WDV is 7 lakh, what you would get is 3. That is, 3 would be your short term capital gain. Everyone. Does the block cease to exist? If the block does not cease to exist, then C minus V is your closing WDV. That is, if the block is still present, then the WDV, whatever is there, minus your full value of consideration. Suppose your WDV is 8 lakh and your full value of consideration received is 6, and 2 would be your closing WDV that you would record, minus if the block doesn't cease to exist, then you can either result in short-term capital gain here, short-term capital loss here. If the block is still present, then you can get in this situation, that is wherein you are going to record your WDV value and flows. Clear? Now, Section 50A speaks about your cost of acquisition in case of power sector assets. Remember the cost of acquisition. See, you are going to apply the WDV of the asset as adjusted shall be taken to the cost of acquisition. In case of the depreciable asset, in case of this, that is in case of your power sector assets, you would consider do the modifications for the WDV assets and you would close. That is, you'll do the WDV as per section 43, subsection 6, which is there in a PGBP chapter. Okay, section 50 AA, not so important section, but still computation of capital gain in case of market linked debentures. Always remember, in case of market linked debentures, you're always and always going to get short term capital gain only. You can never get long term. Okay. So, and you are going to capital gain or compute it. How you are going to compute is that you are going to subtract the cost of acquisition of the debentures or the units from the total considerations, and then you are going to get no deductions of STTs allowed in calculating the capital gain. Okay. So section 50B speaks about the capital gains in respect of the slum sale. Remember and understand one thing, people, the undertaking which is held for a period more than 36 months, that is before transfer. What is meant by slum sale? Slum sale is nothing but the actual industrial undertaking. If you are having a unit, one unit you have, one industrial undertaking you have, you're not going to classify your asset as land, building, as machinery, furniture, nothing. Individually, you're going to record, okay, this valuation is 10 crores. Entire undertaking value is 10 crore. You take it or you leave it. That is, slum sale means you're selling your industrial undertaking as a whole, not individual assets over here. Okay. In case of this undertakings, which is held for a period of 36 months before transfer, that is, your hold it before 36 months, that is, you have held for a period of minimum 36 months, it is going to be considered as long term and it is taxable at the rate of 20%. If it is held for a period less than 36 months, then it is going to be short term capital gain, normal rate of tax would be applicable. Now, computation of the capital gain on the slum sale. What do you mean by computation of capital gain on the slum sale? Means for this industrial undertaking, whatever you are selling, the calculations of your capital gain is going to be little bit different. That is, you are going to consider your full value of consideration minus full value of consideration minus your actual cost of consideration. You are going to get your capital gain. How do you going to determine this full value of consideration? Means it is either fair market 1 or fair market value 2, that is whichever is higher would you would consider. What is your fair market value 1? People remember, fair market value 1 would be your fair market value of the capital asset which is being transferred. Fair market value 2 means the actual sale consideration. Whatever the capital asset which you have transferred, what is the fair market value on the date of this sale of this slum sale, or whatever the amount which you have received as a consideration, whichever is higher would be considered as your full value of consideration. Minus your actual cost of acquisition would be your net worth. Net worth is nothing but the asset minus liability. What is meant by asset? Asset means asset can be in various sort. Depreciable, in case of depreciable asset, you are going to consider the WDV as per the income tax, section 43, subsection 6. Self-generated asset, all of us know there is no value for the self-generated asset, so it is going to be nil. In case of asset which is wherein capital expenditure has been taken under section 35 AD, all of us know if it is 100% deduction is being taken, then your WDV value would be 0. So it is considered as nil. In case of other asset, it is going to be the book value only. You're going to consider everything. This would be the cost of the asset minus whatever the liabilities you're going to take. You're going to subtract that. And then you're going to get the cost of acquisition, that is the deemed cost of acquisition. You're going to subtract that with your cost of full value of consideration. And then you're going to get your capital gain. Clear? Now, so next section 50C speaks about the capital asset being transferred in the case of land, building or both. Okay. See, try to understand what does this section 50C speaks about. This section is similar to that of 43CA. In-depth explanation of this section, if you require, you can go and watch the separate section explanation has been provided in one video. You can go and watch that in my channel. And if you want the notes of all this, whatever you are seeing, this is available in my Telegram channel. The link is provided in the description. You can go and join over there. Okay. Now, capital asset which has been transferred, that is the land, building or both. That is, if your stamp duty value is greater than 110%. I've told you more explanation is there in the separate video. You can go and watch that. If your SDV, people, if the SDV is greater than 110% of your consideration, 110% of your consideration, then you're going to consider your SDV as your full value of consideration. Suppose if the SDV is less than or equal to 110% of the consideration, you're going to consider the full value of consideration as your actual consideration only. Whatever you have actually received, you would consider the same. In case of SDV less than or equal to 110% of the consideration. If SDV is more than 110, then you would consider the SDV. Now comes the question, which SDV will you consider? You will have two SDVs, one on the date of agreement and one on the date of registration. You would consider the SDV on the date of agreement provided whatever the advance which you have received in account paycheck, account pay draft or any other electronic clearance mode only. If you have received in the form of other than electronic clearance mode, then you would consider the STV on the date of transfer. That is on the date of registration, whenever the date of transfer has happened. Clear? This is your section 50C. Section 50CA, that is fair market value. How you would consider the fair market value in course of unquoted shares is that fair market value of such shares would be considered. For unquoted shares, you would consider the fair market value of such shares as your full value of consideration. In case of any other capital asset, fair market value in the date of transfer would be considered as your full value of consideration. Clear?